Hey, good morning once again to all of our options traders out there. And this is a little bit of a follow-up video from the last one asking about the difference between roulette and horses. And so the follow-up question is, did you fall for it again? So what in the world does this mean? Well, I'm talking about the most classic money trap in all of options trading. And so even though we just talked about this topic in the last video, let's see if you fall for it again. And here's the question I'm going to pose. We have two different trades. Trade number one, you have an 80% chance to win. And trade number two, you have a 10% chance to win. Now, of course, we have to define what we mean by win. By win, that you are going to earn some kind of a payoff. So trade number one, you can have wins, let's call them 80% of the time. With trade number two, it's only 10% of the time. So the question that I have for everyone, which do you choose? All right, now I want you to think about it carefully. What does your gut instinct tell you? Which of these two trades is the better one to take? Well, I think it's probably safe to say most of you jumped on trade number one to win 80% of the time. So let's do a simulated game, which we've done before. All right, so there's lots of ways we could carry this out, but this is a very simple one. We're going to throw 10 numbers into a hat, and you're going to win if you draw the numbers 1 through 8. All right, so 8 out of 10 is an 80% chance to win. So the longer we sit here, you are going to rack up wins 80% of the time. So we're going to throw the numbers into the hat and let the games begin. Now, what do you suppose is going to happen? Well, again, what most people look at is they say, hey, this is great because I'm going to win 80% of the time. And the point of this video, as was the last one and many before, that's not enough information. We have to consider the probabilities or the odds. So an easy way to figure this out, what the long run outcome is going to be, you recognize that you have 8 ways to win and 2 ways to lose. So we can reduce that to 4 to 1. And so we're saying the odds would be 4 to 1 on. On just means that they're in your favor. And because they're in your favor, you would have to bet 4 to win 1. Now, once again, a lot of times new traders would say, oh, that's a horrible risk-reward ratio. I have to bet 4 but can only make 1. Well, that's missing the point. The reason for this ratio is because you have an 80% chance to win. That's what's making the odds balance at 4 to 1. And again, this would be fair value. And in an active market, we would expect that the crowd would, if you could trade these bets, would settle on a ratio of 4 to 1. And here's why. See, most people think of the trade being balanced at the center. I can lose $1 or win $1. But if I can win 80% of the time, it's just that much better. Well, that's true if it were dollar for dollar. But it's not going to be, because you are going to win 80% of the time. And so let's put these as our, let's say, weights on the seesaw. So the seesaw is not going to balance here. We have 4 times the amount of weight over here on the left compared to the right. So what's going to happen in an active market, if this little blue triangle here, the fulcrum, is the price, traders are going to bid the price higher. How much higher? So that the seesaw is in a ratio of 1 to 4. This side of the seesaw has to be 1 unit, this side has to be 4. And so by giving this side 4 times the length, it balances out this relatively small weight out here of $1. And so we can balance at this level. And again, in an active market, that's where the market would settle. So the question that you always have to ask yourself is not, do I think that I have a good chance of winning, or do I think the stock is going higher, or do I think earnings are going to be good? That has so little to do with the trade. You have to ask, what about price? All right, so again, traders forget to ask about price. They get so hung up on, what do you think the stock is going to do? Do you think they're going to beat earnings? And again, that's the wrong way to approach it. So in this example, we have 4 to 1 odds is fair value, which means you'd have to bet 4 to make 1. But what if the market priced this at $4.10? See, you're still going to win 80% of the time. Are you still interested in the bet? Well, here's a computer simulation betting $4.10 to win $1, even though you're going to win 80% of the time. See, when the seesaw is out of balance, this becomes the long run outcome. Now, here's a chart in Excel. I ran this actually 30,000 times. And as always, when the odds are against you, you might beat them in the short run. You can see up here, you were above zero. Remember, what we're tracking is your profit and losses. But over here at the far right side, and it doesn't take that far to start heading into losses, you absolutely will end up in losing territory, even though you're winning 80% of the time. Well, that was if you're betting 410 to win $1. What if the market priced it at 420? The price is even higher now above fair value, and the higher it is, the worse it gets. So here's another simulation, 30,000 tries, paying 420 to win $1, even though you're going to win 80% of the time. So hopefully this shows this is not the question. If you're after profits, not winning percentages, this is not a good deal. And I have a suspicion that most people fell for it. They go, I would rather win 80% of the time, instead of saying, well, it's not really complete information. What about the price? See, that's the part that everybody forgets. So let's look at the other side. What about the opportunity where you could win 10% of the time? Now, again, most traders would say, that's a horrible deal. I'd much rather win 80% of the time. Well, let's go through the motions again. If we throw 10 numbers into a hat, this time we're going to let you win if you draw the number 1. We're going to throw the numbers into the hat. We're going to play this over and over and over. So because you can only win with one number out of 10, you're going to win 10% of the time. And that's where most people stop with their analysis. You can't. You have to say, what about the probabilities versus the price? That's the trading question. So here you've got one way to win, 9 ways to lose. So we know that the odds are 9 to 1 against you. And so if the odds are against you, now you get to bet the small number, you get to bet $1 and maybe make the big number. You can bet $1 to win 9. But that's because the odds are against you. And so this would be fair value. And we figured it out very easily by just looking at the odds. So if we go back to our seesaw, now look at the weights. We have $1 on the left and 9 on the right. So clearly the seesaw is not going to balance here in the middle. But once again, that's what people overlook. They assume that if you are winning 10% of the time, that you're going to be betting $1 to make $1. And the crowd's not going to fall for that. Of course not. They recognize that the odds are against you. So they're going to push the price down. And they're going to push that price down until our little balancing point ends up in a 9 to 1 ratio. So if this little $1 bet over here has 9 times the length compared to the $9 potential reward that only has 1 unit of length, the seesaw will balance. And that's another way to figure out where the crowd is going to end up stabilizing. If you have to pay more than $1, people don't want it. They're going to sell it, push it back down to $1. If it's below $1, people will, relatively speaking, find it a good deal and bid the price up. So in the long run, we should balance somewhere around a ratio of bet $1 to make 9. So see, once we ask about price, it changes things. So again, the theme of this video is traders forget to ask about price. Don't just stop with what do you think the stock is going to do, or what are earnings going to be, or the FDA announcement. And yet if you watch most of the videos on YouTube, or even most of the talking heads on TV, that's what it's always about. Here's what I think NVIDIA is going to do. Here's what I think Bitcoin's going to do. Nobody asks, what do I have to pay for that bet? So here we saw that you had 9 to 1 odds, we would figure to be fair value, which again means you could bet $1 to make 9. And if that were true, you would just break even in the long run. But what if the market priced this at 90 cents? Something less than $1. See, so even though you're only winning 10% of the time, If we go through our simulation here of 30,000 tries, this is what we get. Here's 0 right there. And look at this, almost all of the results above 0. Looks like we might have dipped below 0 very, very early on. But again, anything can go against you in the short run. So even though this is a good bet because it's priced below fair value, you could still lose in the short run. Now, yes, you're still only going to win 10% of the time, but you can see it doesn't matter. If you're after dollars, this is the far better trade. And if it were priced at 80 cents, even cheaper, then the results get only better. So the main point to take from this video, did you forget about price? And if you did, you have fallen for it again. You stepped into the same trap. So notice when I presented that you could win 80% of the time, fair value was 4 to 1. If the bet is less than $4, it's worth taking. See, now you can answer the question. If you have to bet more, it's not a good deal. On the bet where you could win 10% of the time, fair value was 9 to 1. You had to pay 1 to make 9. If the bet is priced less than $1, where you could bet 90 cents or 80 cents, it's clearly worth taking. If you have to bet more, it's not a good deal. So notice what both of these bets have in common. Anytime you are betting less or paying less, it's worth taking. Paying less than fair value. That's the question. And anytime that you had to bet more, regardless of the percentage of times that you're going to win, it's not a good deal. That's the way to answer the question. So if you go back to the initial question, which would you rather take, an opportunity to win 80% of the time or 10% of the time? Hopefully you realize that's not enough information. You have to say, what about price? So don't get focused on what you think the stock is doing. Instead, always be sure to ask if the option appears to be underpriced. That's the way to approach options trading. And of course, that means you need to understand implied volatility. Remember, the market doesn't care what you think, but the math does care about the price you pay. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.